Welcome back. A few weeks ago, I published a deep dive on Nubank. At the time, I concluded that the market appeared to be pricing a materially worse outcome than the data supported. Stock price had fallen quite a lot, having reached $18.50. At the time we last published, it had fallen down to towards $12 and continued to fall. But we had, on analysis, decided that we were going to continue to hold. At the time, I concluded that the market appeared to be pricing a materially worse outcome than the data supported. And since then, we've continued to research the stock and digging much deeper into the Brazilian economy, Nubank's underlying underwriting philosophy, and risks surrounding consumer credit. And after doing that work, we are strong in this stock. We've continued to hold, not just hold, we actually increased our position by approximately 70%, purchasing additional shares at around the $13 mark, all the way up to $13.60. So I'd like to explain why we are keen on NU and just get into our further research. I think what we've done is illustrate an important investing principle, and that is that great investments are often made when uncertainty remains high, but your estimate of the probability distribution is improved. So at the moment, it's the weather's not clear on NU, but we think the market is being unduly pessimistic. We think that having done all this work, the probability of the bull case has improved and the bear case has lessened. And I'd just like to ask you a question at the outset. So when a really good business like NU does fall sharply, do you buy it because simply the price is lower? Or do you first ask whether the market is correctly pricing in the risk? Today I'll explain why, after several weeks of research, we decided to increase our exposure to Nubank. So our original thesis, when we first started looking at Nubank, was that the market was worrying about one thing above all, and that is credit. And that concern is understandable because Brazil had very high interest rates and inflation remained above target. Economic growth was slowing, and Nubank had never experienced a severe credit cycle. So the market was not giving NU the benefit of the doubt. It had never gone through a bad credit cycle before, and just decided to start selling. I mean, interest rates in Brazil are very high, and so the market is simply saying, well, we don't believe that the Brazilian consumer can weather this storm, and that NU is going to be punished with severe credit defaults. So the bear case was quite straightforward, and that loan losses would sharply rise. Returns on equity would fall, and the stock deserved a much lower multiple. And that was the question that we set out to investigate. So we didn't start with a valuation in this case. Notice that what we didn't do, we didn't build a discounted cash flow model, because it was pretty obvious that the stock is cheap if major credit issues are avoided. We didn't debate whether the stock should trade on 15 or 20 times earnings. Instead, we asked different sorts of questions. What outcome is the market pricing, and how likely is that outcome? And that led us into weeks of research. Brazil's macroeconomic history, previous credit crises, Nubank's balance sheet, provisioning, NPL migration, funding, customer behavior, AI-driven underwriting, and perhaps most importantly, the Brazilian labour market. So a lot of work just trying to quantify the risks. So it's not a very obvious one, Nubank. And so our biggest insight, having done all this work, was that the most important variable wasn't inflation. It wasn't even the Selic rate, the central bank target interest rate. Rather, it was employment, the employment rate in Brazil. Consumers generally default because they lose income, not because inflation rises from 4 to 6%, let's say. As long as people remain employed, they continue to service their debt. So, instead of obsessing over inflation, we began asking different questions. Is Brazil likely to experience significant employment weakness? Today, our answer remains probably not, at least not over the medium term. Why? For several reasons. The Brazilian Central Bank, the BCB, continues to demonstrate considerable discipline, and that gives us confidence that a currency crisis remains unlikely. The recent easing in Middle Eastern hostilities has also reduced an important source of energy-driven inflation. And the government's pre-election fiscal stimulus should continue supporting employment and household income. So growth is slowing, but slowing growth is a very different thing from a recession. And recession is very different from a systemic credit event. What about Nubank? This research also changed how I think about the business itself. Initially, I viewed Nubank primarily as a fast-growing digital bank. Today, I think that's an incomplete assessment. Increasingly, I see Nubank as a data-driven credit allocation platform. Management is not simply trying to eliminate losses. What they're trying to do is maximize long-term risk-adjusted returns, a bit of a mouthful, trying to maximize long-term risk-adjusted returns. Every lending decision is based on expected lifetime value. Every customer relationship generates more data. More data improves underwriting. Better underwriting improves returns. And it's a very powerful flywheel. Importantly, more than 60% of Nu's customers now use Nubank as their primary banking relationship, not just for credit cards, but for deposits and other products, which are increasing by the day. That provides behavioral information traditional banks often don't possess. Why we bought the stock. None of this means that the risk has disappeared. Brazil still faces high interest rates, fiscal challenges, sticky inflation, and Nubank has yet to prove itself through a severe recession, a truly severe recession. Those risks remain very real. But investing isn't about eliminating uncertainty. It's about comparing the market's implied probability with your own. We came to believe that the market was assigning too high a probability to a severe credit deterioration. At the same time, the stock remained attractively priced. Since Nubank announced recently on the 4th of June, a $1 billion share buyback, the stock has already covered by around 10%. We didn't want to wait for complete certainty because by then the market may have already repriced the shares. We believe they're well undervalued. We didn't want to wait for further appreciation. So we increased our position, not dramatically. We didn't back up the truck, but enough to bring the position closer to our level of conviction. So some final thoughts. One lesson I've learned over many years of investing is this: markets don't reward certainty. They reward being approximately right before certainty arrives. Our thesis may still prove wrong. Employment could weaken, inflation could remain stubbornly high. The Brazilian consumer could come under greater stress than we expect. And we'll continue monitoring these risks very closely and keep the stock in a tight leash. But based on the evidence available today, we believe Nubank offers an attractive balance between risk and reward. Not because the future is certain, but because we believe the future is likely to be better than the one currently implied by the market. So I'll leave you with this question. As investors, are we trying to predict the future, or are we trying to estimate probabilities better than the market? Because I think that's where long-term investment returns are really made. The best investments are rarely made when uncertainty has disappeared. They're made when uncertainty remains high, but disciplined research reveals that the probable outcome is better than the prevailing narrative. Thank you for watching.